Reminder.
I just recorded. I don't think it was recording. Carly, sorry, honey.
Okay, great. I'm going to start
Sorry.
over, everybody. No
Sorry.
worries. No
Another
worries.
reminder. Another reminder.
All right, everyone. Hello, and welcome to Calling All Real Estate Investors. We are here every Tuesday at 1:30 p.m. Pacific time and 4:30 p.m. Eastern time for a live event with Caeli Ridge from Ridge Lending Group. Please today utilize the chat feature if you have any questions throughout the call, or you can use the raise your hand feature and we will call on you when applicable. Another reminder, we love participation throughout these calls always, and especially today. Caeli will be discussing Cash Out Refi Rules, and we're going to have a few questions and polls along the way for you to participate in. So please definitely do so. And I will hand you off to Caeli.
Thank you, Miss Carly. Hi, everybody. This is live. I'm back for the first time. I feel like it's been a year, but I think really it's only been about 6 weeks. So thank you for being here and taking your time in the afternoon to be a part of this education, ongoing education for real estate investors. Real quick, so it's Carly and I now. I think I mentioned this in when I was down in Tucson. That she is going to be kind of my co-host, and her and I are learning together some of the technology of this. And as a result, I took over being host and she's co-host. So now I have to keep an eye on the participants and admit them in. So if anybody is a Zoom aficionado that knows how I can remake her the host, so I don't have to keep an eye on admitting people as they pop in, because usually people come after the first few minutes, please put that in the chat for me and I'll figure it out, because I don't see it here easily. Carly, if you find out, let me know and I'll make you the host again and blah, blah, blah. Anyway, hi, good to be back. Thank you for being here again. So today, you guys saw the headline. What we're going to be talking about is cash out refinances, and this is your pop quiz. And the more participation, there's another guest, I'm sorry, you guys. The more participation we get, or who is participating the most or answers the most correct questions, is going to get a prize. And that prize is going to be $200 off your next loan with Ridge Lending Group, whether it goes to the appraisal or lender fees or whatever. So $200 kind of gift certificate to be used towards your next loan with Ridge Lending Group. So participation, I'm doing this, you guys. I know it's not a huge concession here, but I'm doing this to kind of garner more participation. I want to hear what you guys have to say. And where your comfort levels are with understanding, and in today's case about cash out refinance. So let me just get started on that. There's a little bit of housekeeping stuff I want to start with. And you guessed it, yes, it's about interest rates, everybody's favorite topic. And I'm going to have some polls that Carly's going to put up. I'll trigger you, Carly, when I'm ready for you to ask. I think most of them are yes and no questions. But first, let's talk about interest rates. Everybody's very obsessed, always obsessed. No matter what I say, everybody really wants to focus on interest rates. So I want to address a few of those talking points. First, let's talk about real time. Most of you, if you're watching the headlines about this and your feed comes up, you know that the Feds are meeting today and tomorrow. We're going to hear pretty soon. Sometimes they do it on the first day. A lot of times they do it the second day of the Fed meeting, what they're going to do with the Fed fund rate. And there's been a ton of speculation over the last couple of weeks, as there always is, about what Mr. Jerome Powell is going to be saying they're going to do, what they voted on. Many people think that they're going to pause. A lot then on the adverse think they're going to increase another 0.25%. You know, I hope they pause, but I'll tell you something, that from the lending perspective related to mortgage interest rates, secondary markets, Wall Street, they tend to already bake in the worst case scenario. So the interest rates that we've been quoting for the last week, 2 weeks, already assumed that the Feds would be raising 0.5 point. I noticed that yesterday and today we saw a little bit of improvement in mortgage-backed security rates, but as of later today, this morning we woke up and rates were posting pretty well, the best that I've seen them probably in the last 2-3 weeks. And then lo and behold, we had an intraday reprice to the negative. So rates are kind of back up a little bit. So that's where we are today. I'll give you some specifics in a minute. What are they going to do? Let's hope they pause. And if they do, I think we can expect some improvements later this week and maybe for the trailing weeks after that. I don't think we're done with the rate hikes. In fact, I would put big money on the fact that we're not done with the rate hikes unless some catastrophic event befell us. Hold on, I got to let people come back in. Admit all. Yeah, Carly, I can't see where to put you back as host. So if they pause, I think that we might be in we might have an opportunity to strike while the iron's hot, get a little bit better in rate. Otherwise, I would be prepared for more rate hikes this year. We are not at the inflationary rate that the Feds have been absolutely clear about meeting. They're going to get there at all costs. So be prepared for some of that. I would tell you guys, and I think that I predicted this last year, that some easing of interest rates. I think I said sometime around fall, maybe mid to late fall of this year. Let's hope that I'm right. Otherwise, if we continue to kind of see these amazing job reports, which are not working to our advantage, it's funny because it's a double-edged sword, right? We want the economy to be doing well, but the better we're doing over here, the more we're going to continue to see those interest rates go up. The last job reports, I think that the prediction was 195,000, and it came up with 335,000 new jobs. So that didn't help us in the rate sector. All right, as I'm dribbling on about this, I'm still going to hold tight on starting to see maybe some potential rate improvement mid to end of fall of this year. And if I'm off the mark a little bit, then let's look into 2024 for anything material. And remember, rates will always fall much, much slower than they go up. Rates always go up much quicker than they come back down. So we're going to have to be a little bit patient with it. So that's where we are today. I want to beat the drums, continue to beat the drums about interest rates. Let's ask a question. Here's a yes or no question. Okay, here's poll number one, Carly. How many of you here today are kind of waiting on the sidelines for rates to come down before you make any next moves on any new acquisition and or refinance? List of hands, yes and no. I guess yes, you're waiting. No, you're not waiting. And if it's easier in the chat, Carly, if there's a technology thing, no worries, honey. We'll get it figured out. So far, we got 3 no's. Thank you guys for participation. 4 no's. Keep them coming, guys. Mr. Michael, yes. Ron, yes. Justin, yes. Okay, so right now it's a pretty good mix, 50-50 maybe. We've got stopping us from moving on, but not stopping from creative financing. Good, Chris. I'm glad to hear that. That's actually a great answer. Poll's not working. Okay, we'll get the technology. You guys know what I'm like with technology. I'm gonna put this on me. I won't give this to Carly. I'll take it. Technology and me, not so much. Okay. Let's just take another minute and talk about interest rates before I get into today's topic. One of the things that I feel like is missing from a lot of people's mental Rolodex when we talk about interest rates, and especially those that are kind of waiting on the sidelines for rates to come back down before they do anything, because their expectation for monthly cash flow, or maybe the market they're looking in, or their strategy, whatever, has been depressed. They haven't found a way to reinvent themselves and or set that new expectation. Those that think that they're going to get $300, $400, $500 a month of positive cash flow on a long-term rental that they were getting in 2020, 2021, even parts of 2022, I would say that again, single-family long-term rental, we have to classify it. Those days are over. So if your expectation is in that range, you're going to be waiting for quite a while, and in that interim, you're going to be missing out. That is my personal and very strong opinion. You will be missing out on otherwise great opportunities to start your real estate investing. And if you were to do it this way, and if that's your strategy, that's perfectly fine. But keep in mind, whatever your goal is, your long-term big picture goal, if you're going to do it in a way that you're going to wait for the absolute best rates and best cash flow and that expectation, whatever that is in your head, or that ROI number, it'll take you 2 or 3 or 4, 10 times as long to meet those benchmarks and realize those milestones within what your goals are. Okay, so just know that. The other things I wanted to mention to you guys, remember, as rates are high today, what do we as investors do? Do we secure mortgages on a 30-year fixed basis and keep those mortgages for 30 years? How often does that happen? It is excessively rare. I mean, in the fraction percentage. Very, very, very rare do we keep the interest rates we start with especially for non-owner occupied. Maybe not as true for owner occupied. Even for non-owner or owner occupied, it's still a very small percentage. We're already starting to see some people that got their 2.5% and 3% interest rates refinancing into new products to tap into their equity. Most of them are looking at the all-in-one, not everybody, but in any case, you know, you get into those really, really low interest rates and you tell yourself, I'm never going to refinance again. Chances are that's probably not true. Okay, so that's the first piece of this: expectation, setting the appropriate expectations for what the returns need to be, not passing up on opportunities to reach your long-term goals. And then finally, I talk about this a lot one-on-one, and I don't know that I've ever brought it up here in our live events. Those of you that are more focused on the tax benefit, okay, some of you know that you have some tax benefit that you can get at. Others of you are really kind of focused on what you can achieve within the write-offs on your Schedule E, whether it be a business return or your personal return, to mitigate the amount of taxes that you're paying. For you, especially, and if you're in that same category that says you're kind of waiting for interest rates to drop before you do anything, I want to bring to your attention, if it wasn't already obvious, if you had a 4% interest rate, and you probably know if tax benefit is important to you, that you get to write off the interest that you pay on your Schedule E, right? That's one of the deductions that you get to write off. And it happens to be one of the deductions that will not work to your disadvantage when we're calculating debt to income ratio. I won't go into all of that, just to say that insurance, taxes, interest, and depreciation, as an example, those four are add backs. They will not work as actual expenses and harm a debt to income ratio when we figure this Schedule E calculation. They'll work to your advantage, actually. So going back to my point, if you had a 4% interest rate that you're deducting interest on, right, and you've got the cash flow there, what if you had a 7 or 8% interest rate? Is the interest higher that you're claiming as a deduction? Heck yeah, and depending on the loan size, it could be quite a bit higher. So, I'm always beating the drums about doing the math. And I don't know what everybody's tax bracket is and what their circumstances are, so I can't really give you that information unless I'm looking at it with you one-on-one. But if your cash flow at 8% is $200 versus 6%, whatever it is, at $300, okay, again, whatever the numbers, if you're not including what the longer term tax play is going to be there with the extra interest that you can claim versus what you're losing in the monthly cash flow, you should be, okay? Off my soapbox, enough said. If you guys have questions, put them in the chat. I'll answer those at the end. Okay, so polls are not working, right, Carly? Now she can't talk. Okay, all right, so I'm on my own. That's okay. You guys are going to, I've got some clients waiting is what somebody said. One new message. I've let everybody in. I have to unmute Carly. Let's see. Okay, I don't even know how to do that. I'm so sorry, you guys. Oh, I figured it out. Ask to unmute.
Yes. Hello, everybody. So sorry about the technological difficulties. We're figuring it out, but polls are live, Caeli. You'll just have to be the one to, it's down at the bottom there, polls.
Got it.
And it's all, I think, 4 questions, 4 other
Sweet.
questions we had.
Thank you, dear. Okay,
Yes.
guys. Okay. So cash out refinances, this is coming up a lot. There's been some recent changes to guidelines. We usually focus a lot on the conventional. I do have notes and updates for you on the non-QM for those of you that are in that bucket, the all-in-one, et cetera. But most recently this year, a couple of months ago, we had some pretty significant changes to what was allowed for cash out refinances on non-owner occupieds. So here's my question number 2. I think this is also a yes or no question. Let's get back there. Polls and cash out rules, waiting on rates to come down. Caeli question. Missed step. I don't know which is which part, Carly. Do you?
Yeah, let's see. Are you looking to ask who was done or interested in BRRR?
No, it was number 2 on my list. And it was how many of you have recently attempted a cash out? It's misstep. Okay, thank you. Okay, launch. Okay, so here's the question. So those of you that have, it could be BRRRR, it could just be cash out refinance. How many of you recently have gone to do a cash out refinance and then realized that you did it wrong in the acquisition? You purchased it wrong, you didn't add something to the final CD, and one of two things as a result of that, you either had to leave money on the table or you have to wait to get your capital back. That's the question. Oh, good. This is looking good. So it looks like most of you might be really up to speed with what those rules are. We're going to go over them anyway. So far, nobody has made that mistake of purchasing a investment property under the expectation you're going to do a cash out refinance, and you missed the new rules that would have A, either made you wait, or B, you had to leave money on the table. Nobody's done that. That's actually excellent news. So congratulations to all of you. You're paying attention. Okay. So let's talk about, I'm going to ask a couple of questions, and in the chat, we're going to look at, oh, I guess I can share the results. Okay, stop sharing. You guys get to see the results. I'm going to have you guys put it in the chat. I think for me on the next one's going to be a little bit easier. So starting with conventional cash out refinance. Can anybody tell me what is the difference between having extra seasoning requirement versus not in how you acquire the property? Does anybody know the difference between how you have to purchase the property? If I say it, I'm going to give it away. But does anybody know what you have to do in acquisition in order to remove any seasoning requirement on a cash out refinance? It's the difference between purchasing a property one way and purchasing it another way. Anybody? Okay, it's the difference between paying cash for the property and using leverage. Yeah, Justin got it. I was saying it just as you were probably typing, Justin. The difference in the conventional guidelines and the seasoning, the new seasoning requirement, is specifically about paying cash versus using other people's money to acquire the property. Now, one caveat when we talk about other people's money, okay? If we used other people's money and that leverage was recorded as a lien against the property, that will change the seasoning. The seasoning requirement has now extended, and I'm not giving the actual new seasoning requirement because that's one of my questions. I'm not going to give it away. Versus if you used other people's money and it was not a lien recorded, it was just a private note. Your buddy John or Emily said, "Here's the money. Go do what you want. I trust you. I'm not going to record a lien against the property." Now, I wouldn't do that. Chances are none of you would probably do that. But if it were a private note, some kind of a promissory note that was the key was not recorded with the county against the property, then that scenario would fall into an all cash purchase. Okay, so the difference in seasoning is cash acquisition versus using leverage. And if you've used leverage, it would apply if it was a recorded lien. If it's not a recorded lien, we're going to treat it more like a cash purchase. Okay. The seasoning requirement, who knows what the new seasoning requirement is for cash out refinancing conventionally? Yes, Chris, nice. 1 year, 12 months. Who knows what it used to be? 6 months. Good, you guys. Excellent. So they extended the wait time, the seasoning time by 6 months. So if you use leverage, it's no longer 6 months. You got to wait a year to do a cash out refinance. Now, a very, very important distinction, and people constantly mistake this. There is a very distinct difference between a rate and term refinance and a cash out refinance. I want you guys to really focus on this for a second, okay? If you did use somebody else's money, you used leverage, it is a recorded lien, and all you care about doing is paying off that existing lien plus the new closing costs, some people in their mind thinks that's a cash out refinance because they didn't necessarily come to the table with any money, depending on the terms of the first loan, right? That short-term bridge money loan. That's a rate and term refi, guys. The only time it's cash out is when you are physically getting cash in hand. Okay, so make sure that you understand that distinction. A rate and term refinance, no seasoning required. Cash out refinance, when you get cash in hand, is when seasoning is required if you have secured leverage, recorded lien against the property. Okay, everybody clear on that? I mean, feel free to wave your hand or you know, give the thumbs up or whatever you can do on your thing. If you have questions, please let me know. Very, very important when we talk about the the seasoning versus the non-seasoning, all of what I've described in every facet of everything I've talked about so far assumes that we need and are using the ARV, okay? To make things even more complicated, if the deal is okay to use your purchase price, very rarely the case, but if you can use the purchase price versus a higher ARV, appraised value, then the seasoning issues are no longer an issue anymore. We can go immediately without seasoning if we're using the purchase price. Okay, I won't focus too much on that because it's such a rare situation, and I think it confuses people a lot. But if you have questions, feel free to ask me. Everything that I'm talking about with the seasoning and the leverage and the cash, etc., assumes that we need to make the deal work the appraised value or after repair value, whatever the case may be. All right. Okay. Let's say that let's take the cash purchase a step further. This is another common mistake. The rule related to how much cash you can get back in hand. Does anybody know the rule that tells you if you paid X for it, and we know what the LTV maximums are? Let's just say it's 75% of the ARV. That's our max LTV. Can anybody tell me what the max cash you are entitled to get back, the absolute highest dollar amount without seasoning, right? We're in that space where we paid cash for it. We haven't used leverage. We don't have to wait 12 months. Does anybody know how much maximum you can get back in hand? All right, the answer is whatever is listed as your total acquisition cost on your final closing disclosure. So if you paid $100,000 for the property and there was $50,000 in renovation, but that $50,000 was paid the day after closing, and that was sent to the general contractor the day after closing, and your final closing disclosure only said $100,000 on it, the answer is $100,000 plus whatever maybe minor costs were associated with that. That could be part of it. Those are your acquisition costs listed on that final closing disclosure, and that is the maximum on a cash purchase, unless you have 12 months seasoning, in which point then it doesn't matter anymore. But if you want to get that cash back before the year is up, which most of us are not going to want to tie up our capital for a year, unless I guess it's some massive extended rehab thing that's going to take a year anyway, in which case it doesn't matter. But if you want to get your capital back sooner, the rule is you cannot get more money back than is listed on that final closing disclosure. So then the next follow-up question ends up being, well, how I have to pay the general contractor before they start the work? Right? How do I do that? How do I get that on the final CD? The answer is we work with an escrow company that will do what's called an escrow holdback. Okay, both the acquisition, the purchase price, and the renovation cost will be listed on the final closing disclosure. So in my example, $150 is going to be listed there. The escrow company that will facilitate an escrow holdback will distribute the $50,000 to the general contractor in draws that have been pre-approved by you. Okay, so you've got that protection in place so that you're not just handing $50,000 off to a general contractor that you may or may not have a relationship with before any of the work has begun. It is very, very, very important that if you're expecting a scenario where the ARV is so high and our LTV maximums would allow you to get a full $150,000 back, that number, both of those numbers, is listed on your final closing disclosure. Because otherwise, you're only going to get the 100 grand. You're leaving $50,000 on the table. Okay, let's say that that's not a scenario that you can you have any control over, and maybe it's already happened, but the renovation was only 5 grand. Okay, depending on what the ARV is, leaving $5,000 on the table is probably not going to be a make or break for most people, especially if you're getting back the entire other acquisition costs. Right, that's almost 100% leverage. So it's probably not the difference between, you know, whether you would be willing to wait or not. I guess it depends on what that ARV comes out to be. Well, here's another scenario. Okay, let's say that you did it right, and you had $150,000 on the final closing disclosure, and I'm just throwing out stupid numbers. The ARV comes in at 300,000. Okay, somebody do the mental math for me. What's 75% of 300,000? I can't do mental math. You guys know this about me. Come on, who's got it? Let's see who's first. Am I first? 225,000. Okay. Who got that? Chris got it. Chris is on time. So 225,000. Okay. That, let's just say this is a real deal. And I have 150,000. That's my total acquisition cost, my purchase price and my renovation all in. That's every cent that I've spent. I got it on the CD. I did it all right, but my value comes in at 300,000. Okay. I've seen stuff like this happen. It's fairly rare, but whatever. We'll talk about it. Am I going to refinance right now? And I just closed on it, and the renovation is going to be done in 3 weeks, right? And that's all the money that I have to tie up for my next acquisition. Am I going to leave $75,000 on the table and get my money now and, you know, keep going? Or am I going to wait 12 months and get it out then and just let my money sit? Or potentially, what if I were going to instead go get some kind of a short-term bridge loan, a hard money loan, a private money loan? Okay, interest rates are going to be higher. You have a second set of closing costs that might cost you 10 grand, 8 grand, whatever it is. You get the full thing out. Then you come back to us, and then we do a rate and term refinance. No seasoning is required on rate and term, right? So that could be a workaround if you find yourself in a situation where you've done everything right and the appraised value comes in X higher than expected. You have a lot more capital sitting on the table that you could get your hands on. That would be an awesome workaround scenario for you to accommodate getting that cash without having to wait. It does require, you know, 2 sets of closing costs, but if the total closing cost ends up being $20,000 and you're $75,000 richer than what you were going to be before, okay, I'll take the 55,000 and not have to wait 12 months. Anyway, those are things that you can do. Just remember the differences between the cash out and the rate and term refinance. Anybody have any questions so far about, let me look back through. Were there questions on here? Interesting. So you can't pull sweat equity out even if it's under the max 75, under the LTV. Chris, would you, let me unmute you. I want you to ask that question because I want to make sure I answer it correctly, and I'm not sure I understand it. Where's Chris?
Thanks, Willie. So yeah, this was actually interesting. So this happened on my BRRR, where they would, I purchased this property in 2022, renovated half, it was a duplex, renovated half, pulled out a HELOC on it, and then renovated the other half. And the other basically wanted to pull that, you know, that equity, pay myself back this spring, and they only allowed me to take cash out for my expenses for the total property, essentially. So even though the property appraised at 530, I bought it for 350, and I spent $68,000 in renovations, and so the total in was 410,000 or something like that.
But the total wasn't on the final CD, right?
Right. Yeah.
What was this? What was the month of purchase?
The month of purchase was February 1st, 2022.
Oh, you're good. You got a year,
Yeah.
man.
And so I should have been good, but they still wouldn't play ball.
Was it a conventional loan?
It was originally a commercial 5-year balloon, but a credit union bought out the lender and so the credit union was not interested in cooperating basically with anything that was going on the investment sphere of things. But my question comes from, if in that same situation, if the numbers were the same and the appraisal value is much higher than basically your cost, taking it back to that 75% loan to value, can you not take out that extra equity then, even though you didn't spend that money on it, is my question. So if I bought it, say it was worth 600, I bought it for 350, I spent 70,000 on renovations, but there was probably like 10%-ish left of equity in there. So you can't take that cash out then on that 10%?
So if it was not listed on the HUD,
right?
It wasn't listed on there, and it wasn't part of leverage that we're simply paying off. The answer is no, not until you've hit the full 12 months, unless The
Right.
scenario that I just gave you, if you went and got another loan, paid some extra fees, you know, a higher interest rate for a month or two, those loans aren't going to have any prepayment penalties, and then turned around and did a rate and term refinance to get rid of that higher rate loan where you got all your cash, because they're not going to have the same seasoning restrictions, or they shouldn't. And if they do, you guys need to call me, because we have lots of options for the shorter term money that won't apply any seasoning. So you can get your cash, and then we'll just simply do a rate and term refinance. And rate and term refinances can go to 80%, guys. So there's a little bit more room. Obviously, remember, the higher the LTV, loan to value, the higher the rate is going to be. But you know, we have to factor in and do the math and see how that all plays out. But that would be a perfect example, Chris, of if there's enough spread between what you actually have into it and what it really appraises for, it probably is worth going and paying 2 sets of closing costs. If there's enough spread, if it's $5 grand or 10 grand, I think I did you say 10 grand or 10%? I don't remember what you said, but you know, doing two refinances, one where you're not limited to seasoning, you get all the cash, and then a rate and term refinance to get rid of the higher rate into some 30-year fixed lower rate mortgage. That would be your workaround if you didn't want to wait the 12 months. Otherwise, you're going to wait the 12 months. Yeah. Okay, let me see if there's any other questions. Thank you so much, Chris. Really appreciate the questions and the interactiveness. Let's see what Jim says. What about if you need to rehab? Can you refinance the ARV after rehab is completed? Jim, I think I understand. I'm going to unmute you too. Let's have you ask your question, would you? Hi,
Yeah,
Jim.
I think. Can you hear me?
Yep.
Okay. Yeah, I think you answered it with Chris.
Okay.
Because I'm following what the protocol would have to be. Because I was under the impression that, you know, you could the rate and term refinance. I didn't realize there was an extra layer in there where you had to maybe use hard money. But in Chris's examples, there's so much equity in there. You would want to get that out as quickly as you can.
I would.
Yeah. So it I mean, can you use, well, no, I guess you probably couldn't. So you would probably want to do a hard money. And how quickly, I know some hard money lenders require you to wait a couple of months before you can refinance out of them. I mean, could you try and get out of it within a month if you?
Oh yeah, ours you could. There's not going to be any restriction, right? They'll get maybe a month's worth of interest, and they're making it on the fees up front.
Right.
You know.
Right.
Yeah.
But if you have that much equity in it, then it makes complete sense, you know, than waiting another 11 months to get it done.
I totally agree, because who knows what's going to happen in 11 months, right? The cost of money. I mean, we just don't know. So I would
Price
say
of
that
the home could go down. You could lose your
totally.
equity.
Exactly right, Jim. Great point. So yeah, if it means it's an extra 10 grand to get it 50 or 60 or whatever the numbers are, you guys, you'll do the scenario and crunch the numbers. But yeah, that would be your workaround to not having to wait. If that were the scenario and there was an extra bit of cash you can get your hands on and it didn't fall into any of the current scenarios, go get a short-term private money loan and then rate and term refinance it, because there is no seasoning requirement to take the ARV, and simply pay off the existing lien plus whatever the new closing costs are. So if the numbers were correct, you wouldn't have to come out of pocket with anything, right? It would all be rolled in there. Excellent. Thank you, Jim. Did you have anything else?
No, that's it. Thank you. Thank you for
bet. Yeah. Okay, let me take a look at my notes, you guys. What have I not gotten into? What time is it? Okay, we're a little over. We'll just finish this out. I talked about that. So, you know, if you find yourself in a place, and I know this is a lot, please keep in mind that we here at Ridge, we eat and breathe and sleep this stuff. We do it all day long. It's committed to memory. And even when it isn't, I have cheat sheets and team members that I can go to and say, you know, what's the newest on this thing. You guys don't have the same access that we have, and you're certainly not doing this stuff all day, every day. So what I would recommend for anybody that is questioning themselves, or did she say this, or was it this, or I can't remember that one extra detail, it doesn't matter. Send us the scenario. Ideally, if you really want to be slick, send us a draft closing disclosure before you sign in blood. Okay, let us see it. We want to make sure that everything is line itemized the way in which you envisioned it, and will maximize whatever your return and or your cash back is going to be, so that you're not leaving any money on the table. Okay, so that's what I would suggest. I would say, send us a draft of the CD, the scenario. Let's go through it, and then we can give you our advice. And if we see something that sticks out that we think might be a better solution, we'll offer that up too. Okay, so let's just real quickly, let's get into non-QM and all-in-one, and then if there's any trailing questions, we can certainly do that. So not really any change with the non-QM. It's still 6 months. So I guess that would be another thing. If you know, let's say none of the other things that we've talked about fit your model, non-QM hasn't made the change. We're still at 6 months to pull that cash out. Remember, on non-QM though, you guys are going to have prepayment penalties. So that may not be the best outlet or resource because they're minimum usually about 3 years. You can buy prepayment penalties out, but they're extremely expensive. Generally, it's not going to work. So, you know, just keep that in mind. You're going to have to either pay a prepayment penalty to refinance, which many of us are going to be doing come next year, maybe later this year. So there's that. And then finally, I want to touch on the all-in-one. Those rules have not changed either within the seasoning. They are also still at 6 months. Now, I would let you know that there may be a time here in the near future. I may be announcing that they changed it because the all-in-one is notorious for following Fannie Freddie. So that 6 month seasoning for the all-in-one right now, given all the variables we've discussed, might end up being 12 months soon. So FYI on that. But one thing on the all-in-one that I did want to make you guys aware of, a new guideline change, and this is to our advantage. Usually it feels like it's not. So this is kind of nice information. For those of you that remember, we were capped on non-owner occupied to $250,000 in cash back. And to be more specific, let's say that you had $1 million, you were eligible for $1 million line of credit, but you only owed $500,000 on that line of credit. You would not be able to get $1 million line of credit. You'd get a $750 because we were capped at $250 cash out, cash back. Even if you didn't take it at closing, you would only have that $250 on the all-in-one as immediate access on that line of credit. They just upped that to $500,000. So going back to my example, if your scenario allowed for $1 million line of credit and you only owed $500,000, that $500,000 difference of immediate access to that equity is acceptable now. But that is the cap. It used to be $250, now it's $500,000. So that was really good news. I was excited to hear about that. Okay, questions? Anybody have anything? Let me just talk about next week. I got a couple things I'm going to answer here. Carly, you can see the chats, right? Will you check really quickly to see if there's any other questions that maybe I missed?
Yes, and I wanted to remind you as well about the giveaway that you said at the top of the.
Yes. Oh, good. Thank you. Thank you. Okay, we'll look through. I think that I see who my winners are, and we're probably, just because I just could never not decide. I think there'll be a few of you that get the prize. Not everybody gets a trophy, but we'll hand out a few prizes today. Okay, so next week, before I do that, next week I want to share with you guys, we're going to talk about the top 10 things not to do when getting into a mortgage transaction, refinance, purchase, whatever. Top 10 things not to do when getting into a mortgage transaction. And the following week will probably be the top 10 things to do when getting into or getting ready to secure financing for real estate, whether it's your primary or your rental or your second home. It doesn't matter. All of them all of them would be applicable. And then beyond that, this is for you, Eustace. I believe we will have another guest speaker, someone that's going to come on that I've known for many, many years, and talk about self-directed IRA funding. We have outlets and avenues for this, but she is the master of all masters related to that kind of funding. As you know, if you have a self-directed IRA, it has to be non-recourse. You're purchasing the investment inside that asset class, right? And those loans are quite a bit different than other things. So she's going to come on, and I hope she'll be here. What's today, the 13th? It might be I don't know when it's going to be, but it'll be soon anyway. So keep those topics. Thank you for that idea, Eustace. I appreciate it. So for everybody else, anything that's come up that you're interested in, please let us know, so that we can make sure that we have our ducks in a row, and every week we've got new and fresh information to deliver to you that is relevant and timely and all of that stuff. Okay, let's see.
Yeah, just a couple more questions about where to find the recordings. So there's a few places you can find all of our recordings. YouTube, we have a YouTube page, Ridge Lending Group. Everything is there, as well as please join our community, Ridge Lending Group community. Everything is posted in there. That information is going to be on our website, Ridge Lending Group community, or ridgelenడింggroup.com. So feel free to join there, and all of our videos are at both of those sites. So everything all in one, or just all recordings in general. So you can find everything there.
Thank you, Ms. Carly. Okay, so we had some good participation today. I really appreciate it. Let's just see here. So we're gonna go Chris, definitely. We've got Sharnetta, Jim, Michael, there's two Michaels, Michael Fennell, and then Michael, I'm gonna say it wrong. I'm gonna say it wrong, just say Alan. We'll ask him later. And there was somebody else that got a lot of the questions right. Where are you? Justin. If I missed anyone, you guys please keep me honest and email me, and I will go back and review. But they're all eligible for $200 off their next Ridge Lending Group loan. We have it written down. We'll put it in your profile so you get a lender credit at closing. I mean, like I said at the top of the hour, it wasn't a huge amount, or the half hour anyway, not a huge amount, but it's really more to elicit that participation, which we love, you guys. And there's no dumb question, no too small question. Really, that's what we're here for. And we want to have that interaction. And yeah. So as always, you guys can reach us, we're our website, ridgelandgroup.com, toll free 855-74-RIDGE, 855-747-4343, and then info@ridgelandinggroup.com. You can send us an email. Your dedicated loan specialists are on standby as well. We are here for all your scenarios and lending needs. Let us know how we can help. See you next week. Thanks for coming, guys. Oh wait, there's new messages, Carly. Most people will probably jump off. Let's see if there's anything that's important. Woohoo, woohoo. Okay.
Lots
All right,
of
guys.
thank yous.
Okay. We'll see ya. Thanks for coming. Bye, guys.